Part 3, Delving Deeper into Security Investments. In this part, understand the process by which investors open margin accounts to borrow money for purchasing securities. Discover the role of investment properties in helping investors diversify their portfolios. Become versed in limited partnerships, their formation, function, structure, tax advantages, and tax disadvantages. Get to know options and investment vehicle that allows investors to buy and sell securities at a fixed price. Chapter 9, Borrowing Money in Securities, the long and short of margin accounts. In this chapter, understanding the specifics of margin accounts, zoning in on the initial margin requirements, calculating with long margin accounts, summing up short margin accounts. You don't necessarily need cold cash to buy securities. Thanks to the wonder of margin accounts, you can borrow money from a broker-dealer to purchase securities or borrow the securities themselves. Margin accounts allow customers to buy more securities from you as a registered rep than they otherwise would, thus leading to more money in your pocket, a greater commission. However, margin accounts are not without an additional degree of risk, which a lot of people found out back in 1929. Margin accounts are great if the securities held in the account are going in the right direction, but horrible if they aren't. The security industry essentials exam barely touches margin accounts, but the Series 7 goes into much more detail. In this chapter, I cover the Series 7 exam topics relating to short and long margin accounts and show you how to put those math skills to use. And of course, I give you plenty of practice questions. Practice a lot of these questions because this stuff is tricky. The biggest mistake students make is mixing up the equations for long and short accounts. By doing the equations over and over again, you can avoid pitfall. Additionally, the more questions you practice now, the easier the calculations will be for you to recall when you're taking the real exam. Besides the questions within the chapter, you'll also get to listen to some of the other work that we have within the text. So listen up. Getting the paperwork out of the way. Because purchasing or selling short on margin involves extra risk. Not only do the accounts, like all accounts, need to be approved by a principal, but all customers must receive a risk disclosure document, margin disclosure document, which outlines those risks and some of the broker-dealer's rules. Some of the items that must be addressed in the margin disclosure statement include the following. Margin investors may lose more than the amount deposited. Investors are not entitled to additional time to meet a margin call. Firm in-house margin and maintenance requirements may be increased at any time without advance notice. The firm may sell securities in the account to meet an unmet margin or maintenance call without contacting the investor. The investor is not entitled to choose which securities should be sold out of the account to meet an unmet margin of maintenance call. Besides researching the margin risk disclosure document, the customer must sign a margin agreement before any securities can be purchased or sold short on margin. The margin agreement is broken down into three main sections. The credit agreement. Because the investors are borrowing money from the broker-dealer to purchase the securities, they're going to be charged interest on that money. The credit agreement discloses the terms for that borrowing, including the interest rate charge, the broker-dealer's method of computation, and situations under which the interest rate may change. The credit agreement may also be referred to as the interest rate disclosure document. May also be referred to as the interest rate disclosure document. The hypothecation agreement. The agreement states that all the margin securities must be held in street name in the name of the broker-dealer for the benefit of the customer. In addition, it allows the broker-dealer to use a portion of the customer's margin securities as collateral for a bank loan rehypothecation. The hypothecation agreement also allows the broker-dealer to sell securities from the account in the event that the equity falls below a certain level. The loan consent form. The loan consent form gives permission to the broker-dealer to lend the customer's margin securities to other investors or broker-dealers, typically for the short sale of securities. Not all accounts can be approved for margin trading. For example, custodial accounts, IRAs, 401ks, and 403bs, and so on cannot trade on margin. Introducing long and short margin accounts. In margin accounts, investors either borrow some money to buy securities or borrow the securities themselves. As a result, margin accounts come into two varieties, long and short. As you may remember, long means buy. With a long margin account, the customer buys securities by coming up with a percentage, typically 50% of the purchase price of the securities, and borrowing the balance from the broker-dealer. These optimistic investors are hoping for a bull market because they want to sell the security sometime later for a profit. With the short margin account, an investor is borrowing securities to immediately sell in the market. The process sounds a bit backward, but the investor is selling securities he doesn't actually own. Hopefully, for the bearish customer, the price of the security or securities will decrease so the investor can purchase the securities in the market at a lower price and then return them to the lender. When a customer buys securities, he can purchase the securities in a cash or margin account, but when a customer sells short securities, the transaction must be executed in a margin account. Playing the Federal Reserve Board's rules. Playing by the Federal Reserve Board's rules. The Securities Exchange of 1934 gives the Federal Reserve Board, FRB, the authority to regulate the extension of credit to customers in the securities industry. In addition to Regulation T, the FRB decides which securities can be purchased on margin. Regulation T. Regulation T is the Federal Reserve Board rule that covers the credit broker-dealers may extend to customers who are purchasing securities. Currently, for margin accounts, both long and short, Regulation T requires customers to deposit at least 50% of the current market value of the securities purchased on margin, and the balance is borrowed from the broker-dealer. Regulation T is currently set at 50%. However, firms not willing to take as much risk may increase the house margin requirement to 55%, 60%, 65%, etc. When you're taking the Series 7 exam, you should assume 50% unless the question states a different percentage. Regulation T applies not only to margin accounts but also to cash accounts. When customers are purchasing securities in cash accounts, they have a certain number of business days to pay for the trade, 1, 3, or 5. This delay is an extension of credit, therefore it falls under Regulation T. Regulation T also identifies which securities can be purchased on margin and which ones can't. Securities that may be purchased on margin include exchange-listed securities, most NASDAQ securities, non-NASDAQ over-the-counter securities approved by the Federal Reserve Board. Securities that cannot be purchased on margin and cannot be used as collateral include most option positions, rights, non-NASDAQ over-the-counter securities not approved by the Federal Reserve Board. Securities that cannot be purchased on margin but can be used as collateral after being held for 30 days include mutual funds and certain new issues. New securities cannot be purchased on margin for at least 30 days. Since mutual funds are always new issues, they cannot be purchased on margin. However, after holding them for 30 days or more, they can be placed in a margin account and used as collateral. Note: Treasury securities and municipal bonds are exempt from Regulation T. However, they may be purchased on margin. The margin and maintenance requirement on Treasury securities typically ranges somewhere between 1% and 6% of the market value, depending on the number of years until maturity. Municipal bonds can be purchased on margin, and the margin and maintenance securities are set by the brokerage firms based on the risk. Margin call. A margin call, also known as a Fed call, Federal call, or Reg T call, is a broker-dealer's demand for a customer to deposit money in a margin account when purchasing or selling short securities. When customers initiate a margin transaction, they'll receive a margin call for the Regulation T amount, usually 50% of the purchase or short sale. This amount must be paid by the customer within 4 business days. However, if the amount owed is $1,000 or less, the brokerage firm may choose to just add it into the debit balance. If a customer is buying securities on margin, the customer may fully deposit paid marginable securities in lieu of cash to meet the margin call. For both long and short margin accounts, the margin call is the dollar amount of securities purchased or shorted multiplied by Regulation T, 50%. So, for example, if an investor purchases $50,000 worth of securities on margin, the margin call would be $25,000. Here's how you figure that. The margin call equals the current market value of the securities times Regulation T. The margin call equals $50,000 times 50%, which equals $25,000. Opening a margin account. The initial requirements. The initial margin requirements for short and long accounts apply to the first transaction in a margin account only. After the account is established, the investor may purchase or short securities just by depositing Regulation T in the current market value of the securities purchased or shorted. For an initial purchase in a margin account, customers must deposit a minimum of equity in their margin accounts. Currently, Regulation T calls for a minimum deposit of 50% of the current market value of the securities purchased or sold short. However, the Federal Industry Regulatory Authority, FINRA, and the New York Stock Exchange, NYSE, call for a minimum deposit of $2,000 or ask customers to pay for the securities in full. When you're taking a Series 7, pay attention to the wording of the question. Phrases like opens a margin account and an initial transaction in a margin account and so on indicate that the question is asking for an initial margin requirement rather than a margin call. Pattern day trading. If an investor wants to open a day trading account, the initial margin requirement is $25,000 and the investor must keep at least $25,000 in equity, minimum equity, to continue trading. A pattern day trading account is one in which the investor buys and sells the same security on the same day, or sells short and buys the same security on the same day at least 4 times in 5 consecutive days. Portfolio margin. This is another type of margin account for investors who have at least $100,000 invested, although some broker-dealers may require more at their discretion. Portfolio margin looks at the actual risk of securities held as a whole and adjusts the margin requirement accordingly. So investors who purchase safer securities would have a lower margin requirement. By having a lower margin requirement, investors have more leverage and will have increased profits when the value of the securities held are increasingly and greater losses when the value of the securities held are decreasing. Starting long accounts. To open a long margin account, the customer is required to deposit Regulation T or $2,000, whichever is greater. The exception to this rule occurs when a customer is purchasing less than $2,000 worth of securities on margin. In this case, the customer pays for the transaction in full. It certainly wouldn't make sense for a customer to purchase $1,000 of securities on margin and pay $2,000 when he could pay $1,000 if it were purchased in a cash account. Even if the customer pays in full, the account is still considered a margin account because the customer can make future purchases on margin as soon as they have over $2,000 in equity. Here I'll describe how a Regulation T and the FINRA/NYSE requirements affect how much customers have to deposit when opening long margin accounts. Deposit requirements for long margin accounts. By dollar amount of purchase. $6,000, Regulation T requirement, $3,000. FINRA requirement, $2,000. Amount customer must deposit, $3,000. Dollar amount of purchase, $3,000. Regulation T requirement, $1,500. FINRA requirement, $2,000. An amount customer must deposit, $2,000. Dollar amount of purchase, $1,000. Regulation T requirement, $500. FINRA requirement, $1,000. Amount customer must deposit, $1,000. In short, here's how much an investor has to deposit. Purchase price, initial purchase of less than $2,000, amount owed, full purchase price. $2,000 less than or equal to the initial price, but less than or equal to $4,000, amount owed is $2,000. And purchase price, initial purchase greater than $4,000, amount owed is regulation T, 50% of market value. Open and short accounts. The minimum deposit for short accounts is fairly easy to remember. The $2,000 minimum required by the FINRA and the NYSE applies to short margin accounts. Because of the additional risk investors take when selling short securities, the $2,000 minimum always applies, even if the customer is selling short only $300 worth of securities. In this case, the customer must deposit 50% of the current market value of the securities, or $2,000, whichever is greater. Here's a breakdown. Purchase price, initial price less than or equal to $4,000, amount owed $2,000. The purchase price and the initial price is greater than $4,000. The amount owed is regulation T, and 50% of the market value. Calculating debt and equity in long margin accounts. The Series 7 asks you to calculate the numbers in a long margin account, which isn't too difficult if you take it one step at a time. The basic long margin account formula is as follows. LMV minus DR equals EQ. In other words, long market value minus debit balance equals equity. The following sections describe the variables in this equation. Long market value. Long market value, LMV, is the current market value of the securities purchased in a margin account. The LMV does not remain fixed. It changes as the market value of the securities changes. Certainly, if an investor is long or owns the securities, he wants the LMV to increase. When a customer purchases securities on margin, the margin call, the amount the customer has to come up with, is based on the LMV of the securities. With regulation T set at 50%, an investor has to deposit 50% of the value of the securities purchased on margin, minus debit balance. DER is debit balance, also called the debit record or a debit register. It's the amount of money that a customer owes a brokerage firm after purchasing securities on margin. The debit balance remains the same unless the customer pays back a portion of the amount borrowed by either selling securities in the account or by adding money to the account through dividends or payments. Note, although you aren't as likely to see a question on the Series 7 exam, although you aren't as likely to see a question about it on the Series 7 exam, the debit balance may be increased by interest charges imposed by the broker-dealer, which is the swap. Margin call equals LMV times regulation T. Margin call equals $2,000 times 50%, which equals $10,000. Then use the margin call and the following formula to determine the credit balance. DR equals LMV minus margin call. DR equals $2,000 minus DR equals $20,000 minus $10,000, which equals $10,000. Equals equity. The equity is the investor's portion of the account. EQ. When an investor initially opens a margin account, the equity is equal to the margin call. However, the equity changes as the market value of the securities in the account increases or decreases. When an investor has more equity than the Regulation T requirement, he has excess equity. If an investor has less equity than the Regulation T requirement, his account is restricted. Note, when an investor has excess equity, he develops a line of credit known as a Special Memorandum Account, SMA. Remember that the SMA is built into the equity, not in addition to it. When a customer uses or removes the SMA, the equity decreases and the debit balance increases. Putting it all together, the following question tests your ability to determine the debit balance in a long margin account. Mr. Downey buys $1,000 shares of DEF and DEF common stock at $40 in a margin account. After Mr. Downey meets the margin call, what is the debit balance? A. $16,000. B. $20,000. C. $24,000. Or D. $30,000. The correct answer is choice B. I know what you're thinking, this is too easy. The Series 7 guys are smiling down on you. You may actually get a question this straightforward. However, even if you don't, you still need a starting point, and this is a good one. Set up the equation. LMV equals DR minus EQ. Mr. Downey purchased $40,000 worth of stock. 1,000 shares times $40 per share. So you don't need to enter the $40,000 under the LMV, long market value. Next, figure out how much he needs to pay. Multiply the $40,000 times 50%, regulation T, and you know that Mr. Downey has to come up with $20,000, which goes under the EQ, the investor's portion of the account. If the LMV is $40,000 and the EQ is $20,000, the DR debit balance has to be $20,000. $40,000 minus DR equals $20,000. DR equals $20,000. Brokerage firms who don't want to take as much risk may increase their house requirement above the Regulation T requirement. In this case, use the house requirement in your calculations. So, for example, let's say the house requirement is 60% instead of the Regulation T 50%. The investor would have to deposit 60% of the purchase, which would go to equity, and the debit balance, DR, would be 40% of the purchase. Making short work of calculations in short margin accounts. On the Series 7 exam, you may be asked to calculate the numbers in a short margin account. You have to start by setting up the formula correctly. The basic short margin account formula is as follows. SMV plus EQ equals CR. In other words, short market value plus equity equals the credit balance. The following sections describe the variables of this equation. Remember, when a customer purchases securities, he has the choice of whether to pay in full or purchase on margin. When a customer is selling short borrowed securities, there is no option. The transactions must be executed in a margin account. The short market value is the current market value of the securities sold short in a margin account, just as the LMV in a long account varies. Just as the LMV in a long account varies, so does the SMV. The SMV changes as the market value of the securities changes. If an investor is short the securities, selling borrowed securities, they want the SMV to decrease so the investor can repurchase the security or securities held in the short account at a lower price. When the market sells short securities on margin, the margin call, the amount the customer has to come up with, is based on the SMV of the securities. Regulation T set at 50%, and the investor has to deposit 50% of the value of the securities purchased on margin. As with long margin accounts, a brokerage firm may decide to increase the house requirement above the Regulation T requirement. Plus equity. The equity, EQ, is the investor's part of the account. When an investor initially opens up a short margin account, the equity is equal to 2,000 or Regulation T, 50% of the market value of the security, whichever is greater. In a short margin account, the equity increases when the SMV of the securities decreases. When the SMV of the securities increases, the equity decreases. When an investor has more equity than the Regulation T requirement, they have excess equity and develop in the SMA. If an investor has less equity than a Regulation T requirement, the account is restricted. Equals credit balance. There is no debit balance in the short margin account because investors aren't borrowing money, they're borrowing securities. Instead, short margin accounts have a credit balance, also called a credit record, credit register, or CR for short. The credit balance is initially made up of the amount of money the investor received for selling the stock short, the short market value, and the amount that the investor had to deposit into the margin account to pay for the trade, the equity. The credit balance remains fixed unless the investor removes excess equity, more securities are shorted, or the investor covers some of his short positions. For example, say that an initial transaction in a margin account, an investor sells short $50,000 worth of securities with Regulation T at 50%. First, you determine the market call. Market call equals S&V times Regulation T, 50%. $50,000 times 50%, which equals $25,000. Then you must use a margin call and the following formula to determine the credit balance, which equals S&V plus margin call, or $50,000 plus $25,000, which equals $75,000. Putting the equation together. The following question tests your ability to determine the credit balance in a short margin account. In an existing short margin account, Melissa Rice sold short 1,000 shares of HIJ common stock at $30. Prior to this transaction, the short market value of securities in the account was $52,000 and the equity was $25,000. What is Melissa's credit balance after the transaction? A. $15,000. B. $45,000. C. $77,000. Or D. $122,000. The answer that you want is choice D. This question is a little more difficult because the transaction happened in an existing margin account. Prior to this transaction, Melissa had a short market value of $52,000 and an equity of $25,000, which means that the CR was $77,000. S&V plus EQ equals CR. $52,000 plus $25,000 equals CR. CR equals $77,000. Because you know the existing CR, you only need to determine what happened to it as a result of the new transaction. Melissa shorted another $30,000 worth of stock, 1,000 shares of $30 per share. 1,000 shares times $30 per share. So you need to enter $30,000 under the S&V next and figure out how much she needs to pay. Multiply the $30,000 times 50% Regulation T, and you know that Melissa has to come up with $15,000, which goes under the EQ, the investor's portion of the account. If the S&V increases by $30,000 and the EQ increases by $15,000, the CR credit balance has to increase by $45,000. S&V plus EQ equals CR. $30,000 plus $15,000 equals CR. CR equals $45,000. Because the initial credit balance was $77,000 and it increased by $45,000, the credit balance after the initial transaction is $122,000. Not all margin customers have only a short margin account or only a long margin account. A few are the unlucky ones who gets a question asking for the combined equity of a customer's long and short margin accounts can either work out the equation separately as if they're two different accounts and add the equity together or use the following equation: LMV plus CR minus DR minus SMV. LMV plus CR minus DR minus SMV. And let the good times roll. Handling excess equity. A special memorandum account is a line of credit that a customer can borrow from his margin account or use to purchase more securities on margin. If all is right in the universe and the market goes in the right direction, the customer actually has more equity in the margin account than they need, which generates an SMA. If a customer removes the SMA, they are borrowing money from the margin account. Therefore, the equity is reduced for both the long and short margin accounts. The debt balance is increased for long margin accounts. The credit balance is decreased for short margin accounts. After SMA is generated in a long or short account, it doesn't go away until a customer uses it, even if the accounts become restricted. You can think of developing an SMA as establishing credit. After you establish credit on a credit card, for example, it remains there until you use it. SMAs for long margin accounts. When an investor purchases on margin, the customer has a leveraged position, so they have an interest in larger amount and in a larger amount of securities than they would have if they had paid in full. When a customer has a long margin account, excess equity is created when the value of the securities in the account increases and the equity in the account increases above the margin requirement. The following question tests your ability to answer a question on excess equity. Mrs. Gloria's purchased 1,000 shares of Dud Core on margin at $50 per share. If Dud is currently trading at $70 per share, what is Mrs. Gloria's excess equity? A. $5,000. B. $7,500. C. $10,000. Or D. $20,000. The answer you're looking for is choice C. This question throws you a little curveball because you have to set up a new equation when the market price changes. You first need to find the debit balance. Mrs. Gloria's purchased the $50,000 worth of securities. 1,000 shares times $50 per share. So enter $50,000 under the long market value. And then Mrs. Gloria's had to deposit the regulation T amount of the purchase. So enter $25,000. 50% times $50,000. Under the EQ, then Mrs. Gloria's had to deposit the regulation T amount of the purchase. So enter $25,000 or 50% times 50% under the EQ. This means she borrowed $25,000, the DR, from the broker dealer. LMV minus DR equals EQ. $50,000 minus DR equals $25,000. DR equals $25,000. Now the curveball. The LMV changes to $70,000. Because the DR, the amount borrowed from the broker dealer, doesn't change, you bring the $25,000 to your new equation. You find that the EQ has increased to $45,000. LMV minus DR equals EQ. So now $70,000 minus $25,000 equals $45,000. Now multiply the LMV by regulation T to get the margin requirement, the amount that Mrs. Glorious should have in the EQ to be at 50%. Take the $35,000 to $70,000 times 50% and compare it to the EQ. Because Mrs. Glorious has $45,000 in equity, she has $10,000 in excess equity, and $10,000 more than she needs. The R and DR should help you remember the debit balance, because the R and the DR should help you remember that the debit balance remains the same as the market price changes. Some of the margin questions on the Series 7 exam will be related to what happens to SMA during certain events. Remember that when the SMA increases, so does the buying power. When the SMA increases, so does the buying power. If an investor intends to use or withdraw their SMA, it can only be used to the extent that it won't drop the account below minimum maintenance. Loan value. Loan value is the complement of regulation T. So with regulation T at 50%, the loan value is also at 50%. 100% minus 50% equals 50% loan value. Basically, this represents the maximum amount the brokerage firm will lend to a customer based on securities purchased in the margin account. As the value increases or decreases in the short account, the loan value would increase. Let's say the customer initially purchased $20,000 of securities on margin. The loan value would be $10,000, 50% of $20,000. If the value of the securities increased to $26,000, the loan would increase to $13,000, 50% of $26,000. As stated earlier, you can deposit fully paid marginable securities to meet a margin call. So if you have a margin call of $5,000, you have to deposit fully paid marginable securities with a loan value of $5,000 to meet the call. With regulation T set at 50%, The customer would have to deposit $10,000 of fully paid marginable securities to meet the margin call. Because Regulation T is set at 50% of the $10,000 in securities would be used to meet the margin call. SMAs for short margin accounts. Unlike in a long account, an investor with a short margin account earns less equity when the price of the securities in the margin account decreases. An SMA is a credit line that investors can withdraw as cash or use to help purchase or sell short more securities on margin. Excess equity is the amount of equity that a customer has in a margin account that's above the Regulation T requirement. The following question tests your knowledge on determining the excess equity for a short account. Mrs. Rice sold short 1,000 shares of HIG Corp on margin at $60 per share. If HIG is currently trading at $50 per share, what is Mrs. Rice's excess equity? A. $5,000. B. $7,500. C. $10,000. Or D. $15,000. The correct answer is choice D. This question has a twist because you have to use a new equation when the market price changes. Start by setting up the equation to find the credit balance. Mrs. Rice sold short $60,000 worth of securities. $1,000 times $60 per share. So enter $60,000 under the S&V. Then Mrs. Rice had to deposit the Regulation T amount of the purchase. So enter $30,000 under the EQ. The credit balance is $90,000. Next, the S&V changes to $50,000. So you need to calculate the investor's current equity. Put the value under the S&V. In a short account, the CR remains the same as the market price changes. So you need to bring the $90,000 straight down from the previous equation. This means that the EQ has increased to $40,000. Now multiply the S&V by Regulation T to get the amount that Mrs. Rice should have in equity to be at 50%. Compare the margin requirement of $25,000, $50,000 times 50% to the current equity. Because Mrs. Rice has $40,000 in equity, she has $15,000 in excess equity. The R and CR should help you remember that the credit balance remains the same as the market price changes. Playing is smart. Using buying and shorting power for good. Buying power for long accounts and shorting power for short accounts are the dollar amounts of securities a customer can purchase on margin using their excess equity. The short margin account. And calculate both by dividing the SMA by Regulation T. To help you decide the buying or shorting power on a margin account, remember the phrase people who are smart use their buying or shorting power. This phrase can help you remember that to determine the buying or shorting power, you need to divide the SMA by Regulation T. Smart. As long as Regulation T is at 50%, you probably don't need this tip because the power will always be double the SMA. However, if Regulation T or house requirements is anything other than 50%, this formula becomes very important. Try your hand at the following equation. Mr. Smith has a loan margin account with a market value of $20,000, a debit balance of $5,000, an equity value of $15,000, and an SMA at $3,000. If Regulation T is set at 60%, what is the buying power? A. $3,000. B. $5,000. C. $6,000. Or D. No buying power. The right answer is choice B. Because the question is nice enough to supply you with the SMA, you don't have to figure it out on your own. The buying power of a margin account is how much in securities an investor can buy or sell short without depositing additional funds. All you need to do is divide the SMA by Regulation T. Buying power equals SMA divided by Regulation T, which equals $3,000 divided by 60%, which equals $5,000. Buying power for pattern day trading accounts. With pattern day trading accounts, the minimum balance is with pattern day trading accounts, the minimum maintenance is 25%, just like regular customers. However, the buying power is treated a little differently. For pattern day traders, the buying power is 4 times the maintenance margin excess equity in the account above 25% minimum requirement. For regular margin accounts, the buying power is 2 times the SMA. Pattern day traders are prohibited from using cross guarantees and must meet the margin or maintenance requirements of the account independently. In other words, another investor's account, even with a written agreement, or even another account owned by the pattern day trader, cannot be used to meet margin requirements. Looking at limits when the market goes the wrong way. Often securities don't go in the direction customers hope for. When this happens in a margin account, investors lose money at an accelerated rate. If the equity in a margin account drops below Regulation T or house requirement, the account becomes restricted. However, if the equity in the long margin account drops below 25% or 30% for a short account, the situation becomes much more serious. Read on for more info on restricted accounts and minimum maintenance, which is listed here. Checking out restricted accounts. In the previous sections, everything is coming up roses. But what if the market price in the securities held in a long margin account decreases instead of increases? What if the securities in the short margin account show wild success? If this happens, the account becomes restricted. Restricted accounts show up when the equity in the account is below the margin requirement. However, a restricted account doesn't mean that the investors can't buy or short securities in the margin account. Investors may still do so by coming up with the margin requirement of the new purchase. Restricted long margin accounts. A restricted account is calculated the same way as the excess equity, but the investor has less than 50% of the long market value in the equity instead of 50%. Here's a question to test your knowledge on restricted long margin accounts. Macy Bullhorn purchased 500 shares of Element common stock on margin when Element was trading $30 per share. If Element is currently trading at $25 per share, how much is Macy's margin account restricted? A, $1,250. B, $2,500. C, $5,000. Or D, $6,250. The correct answer is choice A. You may notice the similarities between figuring out excess equity and determining whether an account is restricted. If an account is restricted, the account contains less equity than needed to be at 50% of the LMV. First, figure out Macy's debit balance. Macy purchased $15,000 worth of securities. So enter $15,000 under the LMV. Then Macy had to deposit the Regulation T amount of the purchase. So enter $7,500 under the EQ. She borrowed $75,000, the DR, from the broker-dealer. Next, find the investor's current equity. The LMV changes to $12,500. So enter that under the LMV. Because the DR, the amount borrowed from the broker-dealer, doesn't change, bring the $7,500 straight down from the preceding equation. You can find that the EQ has decreased to $5,000. Now multiply the LMV by Regulation T to get the margin requirement. The amount Macy showed. Now multiply the LMV by Regulation T to get the margin requirement. The amount Macy should have in equity to be at 50%. Take the $66,250 or the $12,000 500 times 50% and compare it to the current equity. Because Macy has only $5,000 in equity, her account is restricted by $1,000, 250. You can calculate the excess equity SMA or determine whether an account is restricted in pretty much the same way. If the investor has more equity than needed, it's an SMA. If the investor has less than needed, the account is restricted. Restricted margin accounts. If the market price of the securities held in a short margin account increases instead of decreasing, the situation isn't so great. When this happens, the account becomes restricted. You can figure out whether the account is restricted the same way you figure out the excess equity. Only the investor has less than 50% of the S&V in equity instead of more than 50%. The following question tests your knowledge of restricted short accounts. Mr. Willis sold short 400 shares of RST common stock on margin at $40 per share. If RST is currently trading at $44 per share, how much is the account restricted? A, $2,400, B, $6,400, C, $8,800, or D, $16,000. The answer that you want is choice A. First, figure out the credit balance. Mr. Willis sold short $16,000 worth of securities. So enter $16,000 under the S&V. Then Mr. Willen had to deposit the regulation T amount of the purchase. So enter $8,000 under the EQ. You find that the credit balance is $24,000. Next, find Mr. Willen's current equity. The S&V changes to $17,600. $44 times 400 shares. So you need to put that under the S&V in a new equation. In the short account, the CR remains the same as the market price changes. So you need to bring the $24,000 straight down from the preceding equation. Now you can see, if you've been writing this down, that the EQ has decreased to $6,400, or the difference between $24,000 and $17,600. Now multiply the S&V by regulation T to get the amount Mr. Willis should have in equity to be at 50%. Take the $8,800 or the $17,600 times 50% and compare it to the EQ. Because Mr. Willen has only $6,400 in equity, or $2,400 less than the Regulation T requirement, the account is restricted by $2,400. SOV 17,600 plus EQ 6,400 equals CR 24,000. 50% times 17,600 equals 8,800. 2,400 restricted. Keeping up with minimum maintenance. A margin account can be left restricted, but if a margin account fails below minimum maintenance, the situation is much more serious. Customers then have to deal with a maintenance call or maintenance margin call or Fed call, which requires investors to deposit money into the margin account immediately or in the stockholders or in stockholder lingo promptly. Minimum maintenance on a long account. Minimum maintenance on a long margin account is 25% of the long market value. I'm sure that you'll be happy to know that the calculations are the same as for restricted accounts until you get to the last step and try to follow an equation. Mark Smithers III purchased 1,000 shares of UVW common stock on margin when UVW is trading at $55 per share. If UVW is currently trading at $35 per share, what is the maintenance call? A. $1,250. B. $7,500. C. $8,750. Or D. $10,000. The right answer is choice A. You may notice that the equation looks almost exactly the same as the previous two examples except for the last step. An account may be restricted, but if it falls below minimum maintenance, the customer must come up with enough money, deposit enough fully paid securities, or sell enough margin securities to bring the account above minimum maintenance right away. First, use the market value at the time of purchase to determine the debit balance. Mark purchased $55,000 worth of securities, so enter $55,000 under the LMV. Then Mark had to deposit the Regulation T amount of the purchase, so enter $27,500 under the EQ. You find that he borrowed $27,500 from the broker dealer, the DR. Then find Mark's current equity. The long market value to $35,000. The long market value changed to $35,000. So you need to put that value under the LMV. Because the DR doesn't change, you bring the 27,500 straight down. Therefore, the EQ has decreased to 7,500. Now simply multiply the LMV by the 25% minimum maintenance requirement to get the amount Mark should have in equity to be at minimum maintenance. Take the $8,750 and compare it to the current equity. Because Mark only has $7,500 in equity, he'll receive a maintenance call of $1,250. Minimum maintenance on a short account. As with long margin accounts, short margin accounts can be left restricted, but if a margin account falls below minimum maintenance, the customer gets hit with a margin call. Minimum maintenance balance on a short margin account is 30% of the market value. The rest of the calculations are similar to finding out the short market, the SMA, or how much the account is restricted, until you get to the last step. Minimum maintenance for a long account is 25% of the current market value, and minimum maintenance on a short account is 30% of the current market value. The following question tests your knowledge in determining the maintenance call for short accounts. Mrs. Martinez sold short 1,000 shares of XYZ common stock on margin at $50 per share. If XYZ is currently trading at $60 per share, what is the maintenance call? A, 0. B, 2,000. C, 3,000. D, 8,000. The correct answer is choice C. First, find that Mrs. Martinez's credit balance sold short $50,000 worth of securities. So enter SMV. Then Mrs. Martinez had to deposit the regulation T amount of the purchase. So enter 25,000 under the EQ. Your credit balance is $75,000. Next, find that Mrs. Martinez current equity, the SMV, changed to $60,000. So you need to put that value under the SMV. In the short account, the CR remains the same as the market price changes. So the CR is $75,000. Therefore, the equity has decreased to $15,000. Now multiply the SMV by 30% to get the amount Mrs. Martinez should have in equity to be at minimum maintenance. Take the $18,000, $60,000 times 30% and compare it to the equity. Because Mrs. Martinez only has $15,000 in equity, she'll receive a maintenance call of $3,000.